If you're buying your first home, you've probably heard about FHA and USDA loans. They're two of the most common loan programs for first-time homebuyers, and they both offer low down payments, flexible guidelines, and options if your credit or savings aren't perfect. But they're not the same, and depending on where you're buying, how much you make, and how much you've saved, choosing the wrong one could cost you thousands. So in this video, I'm breaking down FHA versus USDA in 2025. I'll explain how each one works, who qualifies, how the monthly costs compare, and which one is actually better for first-time homebuyers. Because even though both programs are great, one might be a much better fit for you. Let's start with a quick breakdown of what each loan is. FHA loans are backed by the Federal Housing Administration. They're designed to help people who may not have perfect credit or a big down payment. You can qualify with a credit score as low as 580 and in some cases even lower with certain lenders, and you only need 3.5% down. There are no income limits and they're available just about anywhere in the country. USDA loans are backed by the U.S. Department of Agriculture. Yes, the same USDA that's involved with farming. But these loans aren't just for buying farmland. But there's a catch. USDA loans have income limits based on your county and household size, and the home has to be in a USDA eligible area. So right away, not everyone qualifies, even if they'd like to. So let's break this down. If you're buying in a city or even a busy suburb, there's a good chance USDA won't be an option. You can check the USDA eligibility map online. I'll put a link in the description. But if you're buying just outside of town in a rural area, a small town, or more spread out suburb, USDA could be on the table. FHA doesn't have income restrictions. You could make $50,000 or $500,000, it doesn't matter. If you qualify based on your credit, debt to income ratio, and savings, you're good. USDA, on the other hand, does have income limits, and they're based on your household income, not just who's on the loan. So if your partner or family member lives with you and earns income, even if they're not on the mortgage, that could count toward the total and put you over the limit. In most areas, the income cap might be around $110,000 for a family of 4, but in some higher cost counties, it may be more. You can check this using the USDA income eligibility tool. So already we have 2 deal breakers. If the property isn't in a USDA eligible area, USDA is off the table. If your household income is above the limit, same thing. Now let's talk credit. FHA is more lenient. You can get approved with a credit score as low as 580 and still put just 3.5% down. If your score is between 500 and 579, you might still qualify, but you'd need to put down 10%. USDA typically wants at least a 640 for automated approval. Some lenders will go lower with manual underwriting, but you'll usually need strong compensating factors like extra savings or a low DTI. So if your credit score is below 640, FHA is usually going to be your easier path. But it's important to note here that USDA doesn't publish a minimum credit score that you have to have. I've seen some people get approved and they've had like a 500 credit score. In terms of debt to income ratio, FHA goes higher. FHA allows up to a 47% front-end ratio and a 57% back-end DTI in some cases. That means almost 60% of your gross income could be going toward debt payments and still get approved, depending on the lender. USDA allows a front-end ratio of 34% and back-end of 41%, but it can go up to 44%. If you're getting the USDA direct loan, front end is 33% and back end caps at 41%. Debt to income ratio, or DTI, is the amount of money you make versus how much you spend. The front end includes housing expenses like mortgage, interest, property taxes, and homeowners insurance. Back end is all of your housing costs and other debts like credit cards and student loans. It doesn't include bills like electricity or phone bill. You can check out my website, workwithdang.com, for free home buying resources like a mortgage calculator, quick start home buying guide, and a home buyer's course. I can help you find a real estate agent in your area. There's more information on my website. I make content like this every week. Please subscribe if you haven't already. So what about the actual cost? This is where USDA really stands out. Both FHA and USDA have upfront and monthly mortgage insurance. For FHA, the upfront mortgage insurance premium is 1.75% of the loan amount. For USDA, it's 1%, and it's called the guarantee fee. FHA's monthly mortgage insurance is usually about 0.55% of the loan amount per year, while USDA's is only 0.35% as of this recording. So even though both have mortgage insurance for the life of the loan, USDA's is cheaper on both ends. Now, real quick, if you're not familiar with what mortgage insurance actually is, here's a quick explanation. Mortgage insurance protects the lender, not you. It's there because with a low down payment, you're considered a higher risk borrower. So if you default on the loan, the lender still gets paid back. With FHA, it's called MIP, Mortgage Insurance Premium. With USDA, it's called a guarantee fee. They work a little differently, but the goal is the same. You're paying extra to offset the risk of putting very little down. Let's look at an example. Say you're buying a $250,000 home. With FHA, you'd need 3.5% down. That's $8,750. You'd also have about $4,200 added to your loan for upfront mortgage insurance or paid as part of your closing costs. Your monthly MIP would be around $115. With USDA, there's no down payment. The upfront fee would be $2,500, which can be rolled into the loan, and the monthly mortgage insurance would be around $73. So lower upfront costs, lower monthly payment, that's a win for USDA. But here's where things flip. Because USDA has location and income limits, it's not available to everyone. FHA is way more flexible. Let's talk about appraisal and property standards real quick. Both FHA and USDA have stricter appraisal requirements than conventional loans. The home has to be safe, livable, and up to code. Things like chipped exterior paint, exposed wiring, or missing appliances can be flagged and might need to be repaired before closing. That's not a deal breaker, but it's something to be aware of. If you're looking at older homes or homes that need work, your lender can help you figure out if they'll meet FHA or USDA standards. Now, before we answer the question of which loan is better, there's one more thing that doesn't get talked about enough, and that's equity. With both FHA and USDA, you're either putting a small amount down or nothing at all. And in some cases, you're also rolling the upfront mortgage insurance or guarantee fee. That means you're actually borrowing more than the home is worth on day one. So if you need to sell within the first couple of years, or if home prices don't go up in your area, there's a real chance you won't have enough equity to break even. Between the realtor commission, closing costs, and loan payoff, you might end up having to bring money to the closing table, or you may not be able to sell at all. This is especially risky in markets where prices are flat or declining, or if you're buying a brand new home that might lose some value in the short term. It also makes refinancing harder. So even though low or no down payment can be a huge help getting into a home, it does come with some trade-offs you want to be prepared for. So with all that said, what's better for first-time home buyers? If you qualify for USDA and the home is eligible and you're under the income limit, it's hard to beat. You get zero down, lower monthly costs, and a better shot of getting into a home without draining your savings. But that's a big if, because a lot of first-time home buyers either don't live in USDA eligible areas or make too much money to qualify. So for most people, FHA is the default option. It works almost everywhere. It's more flexible on credit. Here's how I usually break it down. If your credit is below 640, FHA is usually the way to go. If you're buying in a city or higher cost suburban area, FHA is probably your only option. But if you're buying in a USDA eligible area, your credit is decent, and you're under the income cap, USDA is probably the cheaper and better deal long term. So there's no one size fits all answer, but that's actually good news. It means you've got options. The key is to work with a lender who's familiar with both programs. Some lenders don't offer USDA at all. Others might push one over the other because that's what they're more comfortable with. You want somebody who can actually compare both side by side and help you make the best decision for your situation. And I want to make sure I mention this. If we were in a perfect world, I'd recommend buying a home with a conventional loan and putting 20% down. That way you avoid mortgage insurance altogether, you start with equity, and you've got more flexibility if you need to refinance or sell later. But I also know that saving up to 20% just isn't realistic for a lot of buyers right now, especially first-time home buyers. That's where FHA and USDA come in. These aren't programs for people with no money. They're programs that give you an alternative to spending all your money up front. Ideally, even if you're using one of these loans, you're still holding on to some savings because life happens. Homes need repairs, emergencies come up, and having some cushion after closing is what makes homeownership sustainable. So the goal isn't just to get into a house, it's to stay in one comfortably. And if you understand the pros and cons of each loan, you'll be in a much better position to do that. If you want to learn about all the major loan types, check out this video. Please like, comment, and subscribe. It motivates me to make more videos.